Welcome, everyone. Thank you for joining us for today's session. We are here to discuss the 2026 Playbook for High Yield and Covered Call ETFs. This presentation is designed as a strategic guide to help you identify sustainable income opportunities and provide the necessary frameworks for avoiding value traps in your investment strategy. To understand our core concepts, let's start by looking at what defines an active ETF. Unlike passive ETFs that track an index like the S&P 500, an active ETF is managed by a professional team. The primary goal is to outperform a benchmark or achieve a specific outcome, such as high income. This structure provides managers with the flexibility to actively buy and sell assets based on market conditions. While transparency is high, with holdings typically disclosed daily, there is a cost trade-off, as these funds generally have higher expense ratios due to the professional management involved. Next, we have the covered call, which is an option strategy used to generate income from stocks you already own. The process follows 3 steps. First, you own the stock, specifically 100 shares of a company. Second, you sell a call option, which gives someone else the right to buy your shares at a set strike price. Finally, you collect the premium, which is a cash payment you keep no matter what happens. The inherent trade-off of this strategy is that you are exchanging potential upside gains for immediate income. Covered call ETFs offer a unique way to generate high yields by automating the complex process of selling options. The process begins with the fund holding a basket of stocks. A professional manager systematically writes call options against these holdings, which allows the fund to collect premiums. These collected premiums are then distributed to investors as a consistent monthly income stream. There are several notable advantages to this approach. Primarily, it provides a high yield, frequently ranging between 7 and 12% annually. The strategy also tends to result in lower volatility because the premiums collected act as a financial cushion for the portfolio. Additionally, it offers a reliable source of passive income through professional management, removing the need for investors to execute complex trades themselves. However, it is important to understand the associated trade-offs. The most significant drawback is capped growth. Because the fund sells the potential upside of the underlying stocks, it will typically underperform during strong bull markets. Taxation is another factor to consider, as these distributions are often taxed as ordinary income. Finally, while the premiums provide a small buffer, they offer minimal protection against significant downside risk during a major market crash. The critical question every investor must ask is whether their yield is earned income or simply a return of their own capital. Not all high yields are created equal. Some funds pay you from profits generated by their investment strategy, represented here by the tree bearing fruit. This earned income is essential for long-term wealth preservation because it represents actual growth. Conversely, other funds may simply return a portion of your original investment, illustrated by the hand removing a brick from a building's foundation. This return of capital can gradually erode your principal, weakening your financial structure over time. To find the answer and understand the true source of your distributions, you must look at the mandatory Section 19A notices, which disclose the estimated source of these payments. Determining the difference is crucial for anyone focused on building and maintaining lasting wealth. Case study number 1 focuses on JEPI, the JP Morgan Equity Premium Income Fund, which we have designated as an earned income payer. JEPI's strategy utilizes equity-linked notes, or ELNs, to generate income from both option premiums and dividends from its underlying stock holdings. When we look at distribution data from 2024 and 2025, we see that distributions were almost entirely classified as ordinary income and qualified dividends. Furthermore, Section 19A findings show that these distributions typically consist of 100% investment income. Our verdict is that JEPI provides true earned income. The fund is not cannibalizing itself to pay investors. Its share price and net asset value have generally trended upward or remained stable over long periods, confirming that the fund actually earns the income it pays out. In case study number 2, we examine QYLD, the Global X NASDAQ 100 Covered Call ETF, specifically as a warning regarding return of capital. The strategy employed by QYLD involves selling at-the-money calls. However, this strategy often fails to generate enough income to meet the fund's high distribution target. A look at the distribution source from a November 2024 notice highlights this discrepancy. A massive 99.49% of the distribution was classified as return of capital, with actual investment income accounting for only 0.51%. To analyze any ETF yourself, you can follow this three-step audit kit. First, find the 19A notice. You should go to the fund provider's website and search for Section 19A notices. Then look for the source of distribution table. A high return of capital column, defined as greater than 50%, is a major red flag to watch out for. Second, check the NAV versus price chart. Examine a 5-year chart of the ETF's share price rather than the total return. A healthy fund will have a price that is flat or trending upward, such as JEPI or Devo. It is considered dangerous if the price is consistently trending downward, as is the case with QYLD. Third, compare the total return to the yield. For instance, if an ETF yields 15%, but its 1-year total return is only 5%, this means the share price dropped 10%. Consequently, your real profit was only 5%. By following these steps, you can gain a much clearer understanding of an ETF's actual health and performance. This visualization illustrates the trade-off in performance between bull and bear markets, specifically comparing the total return of JEPI, a covered call ETF, against the SPY S&P 500 benchmark from 2022 through 2023. During the bear market of 2022, the chart highlights that JEPI falls less than the broader market. While the SPY experienced a sharp decline of 18.1%, JEPI's strategy provided a significant buffer, resulting in a much smaller loss of only 3.5%. This makes JEPI the clear winner for downside protection during periods of market stress. However, as we transitioned into the bull market of 2023, the dynamic shifted. The SPY rallied significantly, posting a gain of 26.3%. During this same period, JEPI rose less, delivering a return of 9.8%. This perfectly demonstrates the primary trade-off. The same mechanisms that protect against losses also cap the potential for gains during strong market recoveries. The key takeaway is that covered call ETFs are strategically designed for income investors. They are intended for those willing to give up participation in large market gains in exchange for a smoother investment ride and enhanced protection when the market turns downward. The modern landscape has evolved following the 2025 tech rally, which created a significant new divide in the market. As of January 2026, the market has matured beyond simple covered call strategies. The recent tech-led growth market highlighted a clear separation between traditional defensive funds and a new generation of high-capture ETFs designed to participate more effectively in market rallies. This spectrum illustrates the current landscape, ranging from defensive stability on the left to aggressive growth capture on the right. JEPI remains the primary example of defensive stability. Moving across the spectrum, we see the positioning of iSPY, SPYI, and JEPQ as they offer increasing levels of growth participation. Finally, on the far right, FEPI represents the high-capture, aggressive growth end of the spectrum. We will now compare these key players across this new landscape. When comparing the leaders of 2026, we see a spectrum of choices tailored to different financial goals and risk tolerances. JEPI is ideally suited for conservative retirees, offering a low risk level and a projected 2025 total return of approximately 9%. While it provides defensive stability, the main trade-off is that it often lags during bull markets. JEPQ is best for tech-focused income, targeting a 16.5% total return. This medium-high risk option provides NASDAQ exposure, but carries the risk of high volatility if the technology sector crashes. For those looking to capture market rallies, iSPY maintains a medium risk profile, with an expected return of around 13%. It utilizes a zero DTE strategy to track more closely to the S&P 500, though this adds complexity and the potential for whipsaw risk. SPYI focuses on tax efficiency, offering a 16.6% total return at a medium risk level. Its core advantage is the Section 1256 tax treatment, balanced against the trade-off of some noted NAV erosion. Finally, for investors seeking maximum cash flow, FEP offers a projected 25% return. This very high-risk ticker provides an extreme yield, but comes with the significant con of extreme concentration risk. Each leader provides a distinct approach to the market, allowing investors to choose based on their specific priorities for return and stability. As we look beyond the basics toward 2026, we must navigate several advanced threats and nuances in the investment landscape. First, consider the rise of zero DTE ETFs. This strategy utilizes options that expire daily, aiming to capture theta decay with high frequency. However, this approach carries the significant risk of being locked out of potential gains during strong intraday rallies. Next is the ROC tax nuance. It is vital to remember that return of capital is a tax deferral, not tax avoidance. While it provides immediate cash flow, it lowers your cost basis, which ultimately leads to higher capital gains taxes when you eventually sell your position. Turning to the yield trap and NAV erosion, the golden rule is to always prioritize total return over yield. A high yield becomes meaningless if the share price, or net asset value, is in a state of constant decline, as this results in a net loss for the investor. We are also seeing the emergence of auto-callable ETFs. As the newest evolution in the market, these use complex structured notes to offer a contingent yield. These instruments are much harder for the average investor to understand and frequently carry higher internal fees that can eat into returns. To protect your portfolio, always watch for these 3 red flags: declining distributions, expense ratios exceeding 1.00%, and high bid-ask spreads. Staying vigilant regarding these nuances will be critical for success in the evolving market. The final framework: matching strategy to your 2026 market outlook. It is essential to recognize that there is no single best ETF. The optimal choice depends entirely on your investment goals, risk tolerance, and, most importantly, your specific outlook for the market. If you expect a volatile or sideways market and prioritize principal preservation, you should consider JEPI or DEVO. Both are selected for their defensive posture and their ability to generate earned income during periods of market uncertainty. If you believe the 2025 tech rally will continue, 2 strong options emerge. You might consider JEPQ for broad technology exposure, or EPI if you prefer a highly concentrated and aggressive cash flow strategy. For those investing specifically in a taxable brokerage account, you should prioritize SPYI. This fund offers significant tax advantages through the use of Section 1256 contracts, which can be a major benefit for your bottom line. Please note that past performance is not indicative of future results. These are complex financial instruments involving options, and it is highly recommended to consult with a financial professional before making any investment decisions.